Hi friends, welcome to another session of Invest Right, where we try to make investing and trading simple. In today's day and age, where so much information is available and everyone is speaking of complicated finance and trading terms, uh, that any new joiner gets scared and feels vulnerable. You switch on any finance channel, they will use such complicated terms that it will confuse any common person like us. But what if I told you that learning about investing or trading is actually not that complicated? It involves answering just four questions. If you have answers to these four questions, I can guarantee you that you can generate enormous wealth from stock market. Today we will explore this topic from two different perspectives, the long-term investor or the trader. So even if you are a trader or an investor, you just need to answer these four questions. Before starting, an humble request, please subscribe to the channel and like these videos. It gives us confidence. So let's get started. Now, let's first understand the mindset of these two market participants. On one side, we have the investor. Investors usually think long term. They analyze the health of a company by reading balance sheet, profit and loss statements, looking at its financials, revenues, profits, assets, and liabilities. They seek gradual, consistent growth while and are willing to wait years to see significant returns. On the other side, we have a trader. Traders are focused on short term. They analyze price charts, look at volume spikes, and technical indicators like moving averages or relative strength index, etc., to take positions. Unlike investors, traders are not overly concerned about companies' fundamentals. Instead, they care more about the price movements and market sentiments. Both approaches have their advantages and risk, and that's what makes the market dynamic. Different players come with varying perspectives and are trying to achieve their financial goals. So you need to decide what type of person you are. Are you an investor or are you a trader? Once you have decided that, we can move further. So the first question is what to buy. For an investor, the focus is on fundamentally strong companies with stable earnings, growth potential, and a competitive advantage in the industry. They analyze of financial reports, assess companies' debt, and check for consistent profitability. The company economic outlook, future growth, business expansion plan, who is the management, how are they, etc., mean more to them. Meanwhile, as a trader, you have to view stocks differently. They analyze price patterns, candlestick formations, momentum indicators. A trader might buy a stock based on breakout above a resistance level, not because of its earnings report, but because they expect quick, profitable price movement. The key takeaway here is that while investors focus on intrinsic value of a business, traders concentrate on market dynamics and sentiment. Now, there are various tools and screens available which can give us the list of companies based on our criteria, which we will share which will share them in the subsequent videos. The next question is when to buy. Timing the market is challenging for everyone, yet it is essential for maximizing return. For an investor, the right time to buy is often when the stock is undervalued or during a market correction. They may use the price to earnings ratio, price to book ratio, or any other market valuation metrics to determine if the stock is trading below its true worth or intrinsic value. Investors believe in the idea of time in the market beats timing the market. Whereas for a trader, timing is everything. They look at precise entry points based on technical indicators like buying when the relative strength index is below 30, indicating oversold conditions, etc. They don't think about companies' quarterly earnings as much as they think about what the chart says right now. This contrast is crucial. While investors wait patiently for value, traders actively hunt for opportunities. Now that we know what to buy and when to buy, the next question is how much to buy. Now, this is a question which is completely based on individual behavior. We can be concentrated or diversified. When we say concentrated means holding less than 7 to 8 stocks, whereas diversified portfolio means holding more than 20 stocks. If you are concentrated means we are playing the high risk, high reward game. If your conviction goes right, you can make huge amount of money, but opposite is also true. That is, if your bet goes wrong, it can severely damage your portfolio. So generally, it is better to start with a diversified portfolio. Then with time, as we gain experience and confidence, we can move towards concentrated type of portfolio. Finally, we come to the most critical yet overlooked decisions: when to sell. Why I say this is the most critical decision, because if this is not done right, then stock market has the potential to take away all the profits. So plan or strategy to exit a stock is most important. For investors, selling usually happens when company story has played out and they don't see much potential in the company, or if the company's fundamentals have weakened. Investors avoid panic selling because they are more focused on the long-term growth. On the other hand, traders must have a clear exit plan before even they enter the trade. They use technical signals like resistance level, Fibonacci retracement, and price targets. They are quick to exit a position if the market moves against them. While investors think strategically, traders act swiftly and decisively. This distinction makes all the difference. Investors sell to protect long-term wealth while traders sell to capture short-term gains. In conclusion, the stock market is a place of contrasting approaches and philosophies. Investors build wealth gradually while traders seek profit from quick strategic moves. There's no single right way to succeed. It's about understanding what aligns with your financial goals, risk tolerance, and personality. Whether you lean towards investors approach or traders approach, if you're able to answer these four key questions, navigate and you can navigate the market more effectively and generate wealth. Thank you for your time. Please understand, in order to make money in the stock market, psychology is more important than strategy. Thus, we are coming up with such videos. I hope you like the video. If you have questions or want to discuss more, feel free to ask them in the comment section. I will personally answer them. Thank you all. See you in the next session. Happy wealth creation, guys.